broadcasting around the world. This is the Hard Asset Money Show. Your wealth, your money, your future. Serious talk about what's happening and how you profit. Hosted by Christian Briggs. Follow him on X at BMC_HAM. Live in 3, 2, 1.
And joining us now to discuss Trump's tariffs is Christian Briggs, economist and CEO of Hard Asset Management. Good morning, Christian. So it looks like what we got in tariffs is higher than what markets had expected. What's your angle on the market decline?
Well, first of all, thanks for having me on the show. But yeah, you're right. The whole markets were a little bit taken back by the amount of the percentage of tariffs yesterday. I think everybody thought, oh, wow, that was kind of at the high range of what they were expecting. But let's look at it this way. And I think that the White House has made some very clear messaging. For 70 years between European and some of the Asian countries, and it's gone for 30, 40, 50, 70 years now, we've been getting ripped off. That's a very, very good statement about what the press secretary said. See, the thing about it is we've been very fair on our side, and now the markets are realizing that maybe Trump is right. However, they're going to take a little bit of a pause until they kind of see the results. So the Dow is down, the S&P is down. We're seeing the NASDAQ really get crushed today, but not unexpectedly. You know, we're looking at a little bit of fear, a little bit of the unknown charted waters, but at the end of the day, the White House is not wrong. What Trump's doing is exactly what needs to be done. We have to level the playing field so the consumer then can start buying a quality product based on the value proposition and not just always about pricing points.
Okay, I want to focus on the market for a little bit, and then we can talk about the broader implications. Is it looking increasingly like there's not going to be a lot of upside for markets this year, Christian?
I think we're going to see a little bit more on the downside, a little bit of a pause and a kind of a breath in the market. Let's look at a couple of the statistical numbers that we're looking at. We're seeing a slowdown in that lower to middle class markets. The wages didn't keep quite up as much as they had hoped for. The inflation did take a bigger bite out of people's paychecks. We are seeing some of the PE ratios come down, and I think the markets are going to take a pause. If you look at luxury items like restoration hardware, all the way down to Nike shoes, both of them are showing a declining revenue and looking like they're going to have some softening in that third, fourth quarter this year, which means Christmas sales could be a little bit lower, which we are expecting. So yeah, the markets are going to take a pause, rightly so. But remember, like any long-term investor, you always look for good opportunities to re-enter the market. So declines are great. It's just another level of entry points. And quite frankly, we needed the pause. We need a little bit of the breath. We need some interest rates to come down because we have a lot of debt that's coming due this coming fall that's got to be renewed, and it could be at higher rates.
So this recent decline today, it comes after an earlier correction a few days ago, maybe a week ago. Do you expect markets to stabilize soon?
I think they'll stabilize and slowly go down. Stabilizing being the sense that you may not see these 1,000, 2,000 point drops like in the Dow or the S&P dropping 100 or even the NASDAQ dropping 400, 600 points in a day. There may be a few more of those coming. I do expect that. There's going to be a little more fear. But at the end of the day, we will see a declining equities markets. But the good news is that could bring down the interest rates, which what would that mean? That means it could spark a resurgence in home buying at the lower rates. Maybe not quite this year, but certainly next year, we could see home buying back in a way that hasn't been seen in the last couple of years.
Will this impact company earnings?
Oh, absolutely. No question. We're going to definitely see a decline in the price to earnings ratios on these stocks, which probably should have been. A lot of these earnings are going to come down. The consumer is going to slow down on their spending. But again, it's a mitigated risk that if you start to look at the long-term value, the short-term pain could equal a really long-term gain. But yes, we're going to see a pause on the earnings, and we're going to see a continuation of declines. Consumer spending will slow down.
What's your assessment on the risk of recession?
Oh, we're in a recession already in the bottom half of America. There's no doubt about it. See, a recession is the contracting of the GDP, but also remember, we also have a personal GDP. So like your income, my income, it's kind of a household GDP. The bottom 25 to maybe 40% of America has been in a contraction now for 2.5 years. Their wages did not keep up with the inflationary pressures that the Biden administration put on the American public. Now we're starting to see it at the top level. When Restoration Hardware gives warning on not only its current but its future quarters, and the stock is down about 40% today. That's the high-end market. The furniture at Restoration Hardware is not cheap. It's very nice quality, mind you, and the tariffs will have a negative effect on them. But they were already in decline. Sales are down, point blank, and that's the top 2 or 3% of America that buys at RH.
Okay, you talked about long-term gain. What are those?
So the long-term gain is real simple. When we manufacture milk, when dairy products here in America go to Canada like milk, there's over a 300% tariff on our milk going into Canada. That's crazy. So the long-term gain is that Canada is going to come to the table. They're going to say, okay, maybe we were playing a little too aggressive on your milk products and many other things. Trump's telling everybody around the world, come to the table. There's no more tariffs that you're going to charge us for our manufacturing. So the gain is going to be renegotiating the deal like Trump did in his first book, The Art of the Deal. He's going to re-examine all the tariffs. Very interesting yesterday when Trump showed exactly what was going to be done. As you can remember in past shows, I said, I don't see him using a grenade. I see him surgically directing tariffs on specific items. That's the long-term gain. Level the playing field on the items you can. Don't make the trading partners such an adversary conflict that you don't have the good communication. So the gain is going to be for the consumer to make the right choice to buy manufactured goods in America, bring the jobs back, be a competitive landscape, and that's exactly where the gain is going to come from.
And it's going to generate significant revenue, right, for the U.S., these tariffs?
It's going to be incredible. I'm going to go back to 2018 because you bring up a good question there by that very statement. See, in 2018, when the tariffs hit first, the whole markets reacted in such a negative way. And I was watching those markets and I said, but wait a second. If you look at the tariffs that we're getting charged as the manufacturers in America and how many jobs we've lost since first term of Obama, look at what Trump's trying to do. Not only did he accomplish the mission, had he had another year or so, because of COVID, obviously shut everything down, he already had brought back 462,000 jobs in less than 2 years with the 2018 tariffs. That is a proven mathematical statistic that you can't deny. So now he's being even more surgical and he's being a little bit more comprehensive on the scope of what he's trying to level. In other words, what goods that are coming in and what goods are going out. He's surgically determining which ones are the most important ones that need to be tariffed or non, and what percentage to bring manufacturing. That's incredible for the GDP. That increases middle class wages. It's a win-win for everybody.
All right, Christian, it's always good to talk to you. That's our time today. Thank you very much.
Thank you.
The Hard Asset Money Show will be right back after a word from our sponsor. Look at how the rare coin market has skyrocketed in the past 2 to 3 years, specifically proof gold, and how their performance has done after Christian Briggs, CEO of Hard Asset Management, put an immediate buy recommendation in late 2019 on United States proof gold. Specifically $20 St. Gaudens gold pieces, $20, $10, and $5 Liberty proof gold, and $10 and $5 Indian Head proof gold. According to PCGS Price Guide, an 1878 $1 J1553 RB grade proof 65 plus was valued at $2,250 in October 2023, and today it is worth $190,000, an astronomical rise of 8,344%. On September 2021, a 1907 cent grade proof 68 was valued at $7,750 according to PCGS Price Guide. Today it is valued at $100,000, rising 614% in that span.